So thank you, everyone. Thanks for joining, and welcome to our session, which is Reframing the Green Opportunity, and a focus on venture building. Thanks, everyone, for joining. So what is at stake? There's no doubt about the urgency and the political and economic will that's gathering around addressing our sustainability issues that we face globally, but that we also face here in Singapore. And the recent green plan by the government is tackling issues such as climate change and global warming. There's a lot of initiatives that are happening. The latest one is one that just happened a few days ago, which is a historical treaty around the protection of our oceans. So it happened, it took, I think, close to 15 years to come to this agreement, but it shows a global concern around how to make sustainability a priority globally. What does it mean from a business perspective? Well, what it means is that we need to change. We need to change the way that we do business. We need to change the way that we invest in business and that we promote business. And at the same time, it's seen as a priority, but it's also seen as a cost. It's seen as a cost by a lot of governments. It's seen as a cost by corporates, by financial institutions. And I think this is where we differ. This panel, and they will explain why, see it as an opportunity. Arup and Oxford Economics, you recently wrote a report that was commissioned by the Prime Minister's Office of Singapore called the Global Green Economy Report. And you uncovered actually that it represents up to 2050 a 10.3 trillion opportunity in transition economy. At Standard Chartered Bank, we also have made some commitments on mobilizing $300 billion in green and transition finance by 2030. And at SC Ventures, welcome to SC Ventures, this is where we are. At SC Ventures, what we do is we build and we invest in new ventures and new fintechs along the decarbonization value chain. And we have a framework around it to measure, reduce, and offset carbon footprints for all participants in the market. So what I'd like to do now is I'd like to introduce our panel members, and I'll start with Marisa. Marisa, you're the Chief Sustainability Officer for Standard Chartered Bank. Welcome, and thanks for joining.
Pleasure being here.
Alex, you're the founder and one of our core members at SC Ventures. Thanks for joining. And James Lambert, you're Director of Economic Consulting for Oxford Economics. Thanks for joining. And finally, Brice Richards, you're Head of Strategy for Arup. Thanks for joining. Maybe we can start by what I mentioned, which is the green report that you just wrote. And if you could give us an overview of what was the context and what you uncovered in that report.
Sure. First of all, thank you everybody for coming. So the Global Green Economy Report actually was not mandated by the Prime Minister's office, but it was based on a project that James and I did for the Prime Minister's office and MTI, where they asked us to formulate the green economy strategy for Singapore. And as you know, the Green Plan was issued a couple of years ago, but then MTI and the Prime Minister's office were quite really asking themselves, okay, we're going to do this green transition in Singapore, but how good is it going to be for our economy? Is it going to increase our GDP growth? Is it going to create jobs? Is it going to essentially boost our competitiveness globally? And so they essentially mandated Arup and Oxford Economics to answer that question. And while we answered that question for the Singapore government and told them this is essentially the green industries that you should focus on in order to boost your economy, we really realized, James and I, that the size of that green economy for Singapore was massive. We're going to tell you how big, because we'll get in trouble. But we realized, okay, that's really, really big. And we realized that there were a lot of countries out there who really saw only the green transition only as a way to avoid or risk climate change. But we're not talking about the positive of becoming greener, which is creating jobs, boosting growth, and creating, you could say, a lot of prosperity. And so we're saying, okay, we've got to tell other countries outside of Singapore, because not a lot of countries outside of Singapore were thinking about that. We've got to see how big that green economy is globally, and this is where we decided to jointly publish that report. And I'll let James talk about the size, because Oxford really talked about the sizing. And what really came out of that report is not only it's very big, and I'll let James talk about it, but it is actually, it's way more than climate change. And when people talk about green economy today, people tend to overly focus on carbon emissions, but the green economy is much, 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 much bigger than that. It involves circular economy opportunities. It is how to reduce waste, protecting the environment, as well as better using the resources, water, electricity, and all these activities that are touching upon not only climate change, but all aspects of sustainability, create huge, huge, huge potential to create new technologies, new industries, new startups, new jobs that essentially are going to turbocharge economies globally in the future. So what we did, not only as part of the Green Economy report, is we came up with a classification of all the potential green economy activities that we see out there. Most of the classification that already exists, that says EU so far have only 50 or 60 identified. We identified more than 500. So that really gives a much, much broader set of sense of what the possibilities are out there. Now I'll let James maybe mention a little bit more about the size of the green economy.
Thank you, Brice, and thanks for having me here today. Yes, so it's very much a synergy with Arup's expertise in terms of understanding exactly how these various industries and technologies might emerge and transform and guiding kind of policy recommendations towards making that kind of thing happen. From Oxford Economics' perspective, we do a lot of kind of long-term climate, macroeconomic climate modelling scenarios. So we're looking primarily at what the potential macroeconomic damage of different climate pathways could be, including both climate change and climate mitigation pathways. The first thing to mention with regards to this being a benefit versus cost is that obviously it's the aversion of the massive costs of climate change over longer term periods, which is the first kind of big number to stand out in terms of what it does to global productivity and economic performance and income levels. But as Brice was saying, if we look at what the kind of transition that we're talking about, this complete overhaul of global energy infrastructure by 2050 to a carbon neutral model, we took that 2050 scenario and we tried to work backwards from there to figure out how we get from where we are now to where we get to then. And we realised that within that, the enormous disruption that's taking place, the first thing that will occur is that there's a new competitive landscape emerges. But through carbon pricing, there are different business models emerge, different innovations that will disrupt every sector around the global economy, and that creates sizable opportunities, at least at the micro level, for businesses and entrepreneurs and investors to compete and win within that context. But the other thing that happens is that there's a necessary emergence of these great big new markets for green goods and services that will be required to facilitate that transition. And we working, as I said, kind of working backwards from where you need to get to, we estimated the size of the growth of a few of those key sectors to understand a sense of scale about what the total kind of value-added contribution to GDP might be from these bits of the economy by 2050. And this is not the entire green economy as conceived by this 500-point taxonomy that Brice is describing. It's more of a sense of scale. But we looked in particular at kind of key industries of renewable fuels, clean energy equipment, clean electricity generation, electric vehicles, and green finance, and picked up those pillars of the economy and tried to understand how within this transitional pathway the value added by those sectors would grow. And we found that we're talking about a market worth around $10.3 trillion to the global GDP by 2050 within those 5 sectors, which is about 5% of global GDP. Now, actually, a lot of this is happening within what needs to happen to get to net zero by 2050. The next decade is critical. The size of these 5 sectors is worth almost half of that by 2030 under this scenario. There's a real urgency, as much as there's an urgency to deal with the environmental damage of climate change. There's an urgent opportunity implied by this analysis as well, because there is a degree to which those who move quickly and who can seize this opportunity will kind of carry that on to the future.
Maybe we can talk about the role of the private sector and financial institutions to accelerate that change. But before we do that, I wanted to talk to Marisa and about the Adaptation Economy report and see if you have similar findings to the Global Green Economy report.
Sure, well, it's a wonderful segue. We did not plan this, but I'm very glad that you touched on the fact that if we open our aperture beyond just climate mitigation, which is really the decarbonization agenda, we see a whole new world of opportunity. That's exactly the way we see it as well. So one of the areas that we were digging into is what we call the concept of adaptation. And this struck me in particular 2 COPs ago when we were in Glasgow, and the entire discussion, the discourse, was around how do we quickly decarbonize ultimately to net zero. And this was taking place across all of the host countries and participants that were there. But in a tiny little corner, we were hearing people raise their hand, particularly in some of the island-bound nations that are here in Southeast Asia, saying, yes, yes, yes about decarbonization, but my economy isn't worried about decarbonization because I'm not contributing to this. My economy is based on just providing basic goods and services access, and climate change is hitting me in a very material way. And you're talking about putting money into decarbonization, but what about money flowing my way to help preserve my way of life? And that was being really not very well heard or understood. And it struck us that we ought to listen a little bit and try to understand this reality for many of our footprint markets. At Standard Chartered, we have 59 footprint markets, and we often talk about Asia as one big similar bucket. And it's not the case. If we subdivide in some ways, and that's even a gross generalization, our Asia economies into middle income, fast growth economies that might be largely dependent on coal as their energy source, yes, decarbonization is a key part of the agenda, but in our frontier markets, it's a very different reality. So in any case, we started to look into this with a number of modelers, academics, scientists, and so on. And when we started to try to put numbers to this so that we could frame this in some way that was digestible by the financial community, because also what I was hearing was when I was engaging with possible capital providers, the first thing I heard was, oh, this is the job of government, not my job as a private sector actor. Second thing I heard was, well, gee, why would we put good money after bad? If this island nation is sinking, aren't we just throwing money, good money after bad, into a big black hole? It's kind of a horrifying thought that would be the discussion, but in some ways you're sympathetic to that narrative. So we said, I actually, was promoting the idea, and our teams were promoting the idea that I do think we need to talk about this in a different way. And now, out of necessity is born innovation. Out of necessity comes a commercial reality. And if we could look at the adaptation economy in financial terms, perhaps something like looking at disaster avoided, and frame that in those sorts of ways that the financial community can embrace, perhaps we could get capital to flow in this direction. So what did we find? We found that if we just invest $30 billion in the top 10 emerging economies between now and a decade from now, we would save 12 times the loss in disaster in GDP. And it's hard to find a 12 times return on anything these days in a low interest rate environment. So this was really provocative to us. That is in the next decade. If we wait and we start investing that money a decade from now, that need would grow to double. So you'd have to invest $60 billion to avoid about $1 trillion problem. So there's an urgency, there's a return on that investment, and there's a real commercial opportunity. What would we be investing in? It is things like resilient infrastructure. If we put a little investment into these areas, we can help these economies withstand some of the climate effects that we're seeing today. If we help people think differently and invest in different agricultural models that can withstand water shortages and pest infestation and so on, we can actually create a source of producing more food for a much longer time in the face of the reality of climate change. So these are real commercial opportunities with real private sector returns, and we're hoping that we can provide a bit of a catalyst to first defining the adaptation economy and then encouraging capital flow and to innovate. So that's what's exciting to us. The final thing I'll mention is that as part of this report, we pulled 150 institutional investors running big pools of capital and asked them if they had any notion of this adaptation concept. And today, very sadly, less than 0.4% of capital flows in the 10 emerging economies that we looked at. These are huge economies, so it's India, China, Pakistan, Indonesia. Less than 0.4% was flowing to these economies for adaptation. However, the good news is 75% of those that we polled said they intended to direct capital in this area over the coming years. So a little bit of a sign of a kernel of encouragement for you. So that's where we are at the moment.
Thanks, and I'll pass it over to you, Alex, to talk a little bit about innovation and creating innovative business models. How do we identify, at SC Ventures specifically, but how do we identify these opportunities in innovative and sustainable new business models?
Sure, and I'll just echo some of what you guys just said, and you just talked about Marisa. First 12 times, I'll take that. And I think it goes to the heart of our point, which is it is a business opportunity, and the business opportunity is arising from the fact that there's a problem to solve. So to your point on innovation, just to debunk innovation, it's actually not somebody singing under the shower and coming up with a great idea and trying to. It may happen sometimes, but that would typically result in a solution looking for a problem, right? Innovation starts with a problem, and then we try and understand what the problem is and come up with ways to address it. And to the extent you're actually solving a real problem, and we all agree this is one, then financial outcome is there. It's an output of solving the problem. And so when we use venture building as a I call it a tool to address problems, really what underpins this ethos, if you will, of innovation is that if we're going to solve a real problem, then we will end up with business models that are grounded in commercial reality, will be validated by the market, and will ultimately be very well sustained, 12 times or more, whatever it is, but will be validated financially as well. And so it makes sense to back these projects. It makes sense to invest in them. Broadly, when we think of rewiring the DNA banking, we want to build, invest along themes that we think are relevant to society, relevant to customers, relevant to banking and financial services, and their relationship with society. And I would argue that what we're discussing here, the green economy, sustainability very specifically, is arguably the biggest theme, and one will live with for certainly the next decade and beyond that.
I wanted to react actually on the sustainability urgency, because I think that's a point you brought up, which is we need to act urgently in the next decade, and you brought that point as well. But at the same time, we are entering into an attrition of economy globally. Some people might even call it a recession in certain countries. Do you think this is going to have an impact on ESG investments, sustainability investments? And what's the reception of private sectors? I think public sectors see it as a huge opportunity right now, but is the private sector following? So maybe I'll pass it over to Marisa.
Sure. Well, I think there's a couple of questions within the question, but one thing that I get asked a lot in this current environment, and it's wrapped up a little bit in recessionary terms or fears, but also in this short squeeze on energy that we are finding with the after effects of the war in particular. And so many people have said, well, gee, isn't that going to put the ESG agenda on the back burner? A little bit of a similar question. And my retort is actually, it has put it in the spotlight. It's been the exact opposite in many respects, because it highlighted the need that we need energy security, we need a plan B, because we were wholly reliant on one system and weren't really thinking about those alternatives. And then if you take that one step further, you say out of necessity, back to my earlier point of making sure that you've got that continuity of supply, then the next place you look is, well, if over the foreseeable future you're going to be on the decline curve of traditional energy source, we better find a plan B's plan B, which is the green solution. And so I'm seeing that proliferate, that concept all over the sustainability arena. So it's not just energy, but that's just a good example. So the enthusiasm hasn't dampened. If we look at the global capital flows toward green, they continue at pace. You see sort of the trajectory continuing to grow. You know, you might have a wobble here and there when markets are digesting the next interest rate increase, say in the bond market. But if you look at global green flows, they continue. If you look at the amount of innovation that is happening, and these business plans are getting funded, people do talk about the valley of death and venture and all of this, but yet I see enthusiasm, optimism, and capital heading in this direction and preferring to head in this direction than into old business models. And I think it's very much what you're talking about. This opportunity is so ripe for investment and for participation that it's almost inevitable that value will be created. And that's where I think we play. I agree.
Just going to build on this. You know, I also think there's a major difference in emerging markets, probably in Asia, specifically, versus 10 years ago, where I was hearing a narrative along the lines of, yeah, I hear you, but I got to feed my population, or even worse, you guys in the West have had centuries of growth and industrial revolution based on carbon. Let us have a few years so we can catch up. And it's unfair to deprive us, in South Asia and East Asia of that. I'm not hearing this anymore, right? So people have come back from this argument big time as they are, as first, as a result of observing what's happening, as a result of reflecting on natural resources, the scarcity, versus the needs of these economies. And also, I think, as populations are beginning to increase pressure on policymakers, around irrespective of the nature of the government, it's a very real phenomenon. And so we're not hearing the conventional, historical pushback from emerging markets, and in fact, much more of echoing what you're saying, much more momentum to. Actually, we're going to embrace this, and it's an opportunity, and so we can reposition ourselves and get ahead of the curve as well.
And and if you think about just from an economic point of view, I think of what drives many of our economies in Southeast Asia. Like, pick one industry, pick fishing. The enormous amount of ingenuity and sustainable solutions that are coming out of feeding fish, fishing sustainably. Even creating fish in a lab, for instance. Which is an incredibly provocative concept as we potentially scale, not potentially, as we probably will scale that.
In Singapore, there is investment for growing
absolutely
meat in labs.
Meat in labs, and seafood is coming, and we know right now in Japan the very first sushi restaurant will be serving the +4++ sushi restaurant will be serving a lab-created fatty toro. I mean, this is profound type of innovation.
That in itself is an emerging industry.
A huge industry.
To your point earlier,
100%.
It's a lot more than just carbon. It's all these new.
And I was going to pick up just really quickly on also regulatory intervention in some respects as being an enabler for a lot of this growth and enthusiasm, particularly in our market. Look at where we sit right here. One of the most wonderful things that's music to my ear as a banker is to hear a regulator say, yes, I have a two-part job. Part one is regulation and making sure we have appropriate guidelines and rules and regulation that will make sure we do things the right way. On the other hand, MAS will tell you the other part of my job is I need to promote the green economy. I mean, they explicitly say that as a regulator. So their policy making is encouraging all of this investment. So there is one more reason why I think we'll continue to have a catalyst for this coming our way.
Yeah, absolutely, and I think I totally agree with what Alex and Marisa, you guys were saying. I think to put it in terms of Singapore and ASEAN term, you're absolutely right to say the economic model that not only Singapore but the rest of ASEAN has been relying on really is being challenged profoundly right now. And the reason why MTI is talking about the future economy is because they realize that a lot of the economic model of Singapore right now, they cannot rely on it necessarily for the long term anymore. You cannot rely on oil and gas and refining that much anymore because the supply chain pressure from Europe are going to feed back into Asia big time. and is actually going to harm the competitiveness of Singapore as a trade hub, as a refining hub, and so right now, and so that's Singapore. Now think about the rest of Southeast Asia, where tourism used to be a huge driver of economy for countries like Thailand, Indonesia, and COVID completely wiped that out. And even though there is a certain move back, they realize that they need to be way more resilient, and actually the recovery might not be as much as they hope. And so right now you have a lot of countries in the regions who are thinking, what is my next economic model? Away from coal exports, away from tourism, which might not necessarily be the main driver of economy going forward, away from manufacturing as well, which is like incredibly carbon emitting, and it's going to get a hit at some point. And so everybody's now thinking, it's like, is the green industry, the green economy, the next driver of the next 50 years of economic growth? And a lot of countries don't know what they should focus on, because if you're Singapore, if you're Malaysia, if you're Indonesia, if you're Vietnam, what green economy means for you might be radically different. Though, Arup, I think you have the question that you ask is also very valid, because of the recession and because of COVID, the main fear right now for a lot of government will be how disruptive is the transition from my economy today to the green economy of tomorrow. How disruptive is it going to be on people's jobs, right? And my current industries. If I have 200,000 people who work in the coal mining industry, I cannot shut it down like this. It's going to put 200,000 people on the street. I need to retrain them. I need to find new growth. So the transition, it's not about the end game. It's about how we manage the transition from today to the end game of 10 or 20 years. And right now there's too much focus on say, we need to green, we need to green, we need to green. But the real questions of governments in the region is, okay, that's fine. We agree that this is good. We agree that it's going to be very big in 2050. But how do we get there, right? And it's going to be about putting rules immediately, because you regulate your coal mining, you turn them into stranded assets, you're creating huge unemployment. Those governments are going to get to implode, right? Because there are too many people that rely on this for their livelihood. So especially for frontier market and emerging market, the real question is not the end game. The real question is that transition and how you make it from point A to point B.
Hello.
Yes.
I love that point. Can't resist building on it. The concept of S-curves and innovation S-curves, which is important. So starts slowly, inflection point becomes really important, flattens out. Hydrocarbons, industrial revolution, flattens out at some point. In innovation land, in corporate innovation land, oftentimes people are a little fearful of cannibalizing themselves, eating their own margins. Maybe we should push this because we have this really good thing going on here. This is exactly how people get trapped on the existing S-curve and neglect jumping on the next S-curve. Singapore as a trading hub, refining oil and gas, Middle East as a production hub, is very aware of the existence of that S-curve and the need to jump onto the next one. How do you do this? Well, first it's hard, it takes capital, it takes an investment in brains, skills building, and it's a very deliberate approach that in country, it really is a national agenda kind of thing, has to take in order to build the skills, the bench across the entire ecosystem of individuals involved to sort of jump from that S-curve to the next one, which we're calling the green economy, for lack of a better characterization today. So it's a really important point.
Do you mind if I pick up on that as well? Because we're doing it as we speak. So two very, very good examples of exactly what both of you are talking about in practice are the Just Energy Transition Partnerships that were announced at COP26. So for those of you who may not be familiar with what those are, there was a recognition in the West that some of the learnings that we've had given the history on this green agenda, could be applied and used to support this very important transformation and transition of the East, or the global South, depending on which way you're looking at it. But what they are is two Western governments committed to take the lead on providing a very significant amount of MDB, multilateral development bank capital, so long as the private sector would match their commitment. And this would be done in partnership with a recipient developing market government in the pursuit of stepping back and taking a systemic look at the entire economy of that country and figuring out how to transition it to the greener solution. So in our region, in Asia, the two JETP countries are Indonesia and Vietnam. So in the case of Indonesia, for instance, it was the US government and Japan that collectively got together to make the commitment to support Indonesia. And they have provided an MDB commitment of $10 billion US, and that's been matched by the private sector. And Standard Chartered it's hard at work alongside a handful of other peer banks. So soft circling now, total of $20 billion, and we are hard at work right now with the Indonesian ministry doing an entire mapping of their entire economy. And it involves a number of things. One is the early decommissioning of coal, and you are spot on when you say the first thing that the Indonesian ministry said is that we've got hundreds of thousands of people employed in the coal industry. So if we are going to decommission early in pursuit of this rapid reduction in our emissions from the coal sector, help us. How do we do it? How do we pay those to pay them out of their contracts? Because these are very real things. Someone's got to be compensated. How do we retrain all of those couple 100,000 people into jobs of the future? And also, what are those jobs of the future? In Indonesia, it's fascinating. I've learned more than I ever thought I would about what is appropriate in a given island. Some islands are windy, you can put wind. Some islands are appropriate for solar fields. Some it's hydro, and so on. So it's not a simple equation. But I love the fact that this ministry is sitting there saying, I'm going to take my sovereign-owned enterprises, I'm going to take the private sector, I'm going to help SMEs, and I want to deploy this capital, I want to do it for an entire green agenda. And the same exact thing is happening in Vietnam with an $8.7 billion commitment from the host governments, and a further 8.7 coming from the private sector. And we, again, are right in the middle of the Vietnamese JETP as well. So these can serve as models, when done right, for a number of other developing markets, and that we live in hope that these things will work quite well, and then we can then go and apply them in the relevant way to other markets.
Yeah, I really love what you Chris and you Marisa are saying, because it links back to a lot of to one of the critical challenges, I think, when it comes to the green transition. And you mentioned skills, and you mentioned Vietnam, and I'll build a little bit on that. From what we've seen, not only talking with the Singapore government and as in government, is the hidden iceberg of the green transition is skills and human capabilities, right? And you guys are aware, like, one of the biggest issues with Singapore is, of course, access to skills and human capital, right? Being a small nation, there is always the idea of how do we develop the right skills in order to be competitive, but there is a pool that is quite small, right? And so when notably we developed the green economy strategy, the first question of the government is like, do we have even enough people to provide the carbon traders of tomorrow, to provide the specialists in e-waste recycling, to provide the hydrogen specialists? Like, we don't have even the mass of people. Are we going to need to import it? Are we going to need to retrain some people in existing industries? Right, and take, for example, like investment bankers and turn them into carbon traders and all these new that would be an interesting. And so in terms of Singapore, the issue of skills and skills crunch is a huge bottleneck for the future of Singapore as a green hub. Right, because right now we have MAS who's talking about doing that, you have MTI that is doing that. Every single agency from BCA and Parks is thinking about greening their own sector, but they're all fighting for the same pool of people. And they all say, oh, we're going to retrain these engineers. I say, oh, that's great, because that's the same engineers that LTA is thinking about retraining to creating green mobility. So you're going to be, like, if you want to be very rich tomorrow, become an engineer in Singapore, because you're going to be retrained up the wazoo, I can tell you that.
Or a sustainability bank.
Or sustainability bank, right? Exactly. So Singapore is a huge issue of capability, is in terms of volume, but in terms of quality. So you mentioned Vietnam. The fact that Vietnam is now awash with capital, like green projects earmarked money, billions of dollars for green infrastructure across energy, transport, all that stuff. The huge issue that they have, and it's been going on for years, is they are struggling to spend it. Why? Because they are lacking the capabilities to plan the projects, deploy the projects, run the projects, and complete them. Which means that there's like their government just don't have the skills to create successful infrastructure projects. And so now when you're looking at all the pipeline of green projects in Vietnam, you have billions of dollars waiting to be spent, and all these projects are like delayed. And so the issue is, right now, the source of funds is no longer the problem. Is how do you spend those funds so that it creates the projects on the ground that will actually change things? And the huge issue, on top of the main C word, which I'm not going to talk about here in like about Vietnam and Indonesia, is human skills, right? And how do you retrain government? Or how do you create project planners? How do you ensure that even like the projects on the ground are going to be well run? And that capability building piece, if it's not solved, it's essentially the money is not going to lead to any changes on the ground.
And all this in the next 10 years.
And all this in the next 10 months, I would say, like 10 years.
But maybe we can go to first the macro trends. Can you give us a little bit of a perspective of the trends in terms of green finance and sustainable investing? Are we seeing a pickup in terms of these trends in the market globally?
I think we touched on a little bit, but yes, I mean, we see capital continue to flow. We see, and a proxy for this is when a green transaction is brought to market, we tend to find them multiple times oversubscribed. So that usually tells you right there the supply and demand equation is in favor of capital looking to find homes. So yes, the willingness is there. We see from a fundraise basis, even when the markets got a bit wobbly with some interest rate rises and traditional funds were struggling to get capital, we were seeing capital move into green opportunities. And we're seeing also a specialization. So another maybe trend I would point to is not in the not too distant past, you had very generalist green funds occurring. Now what you're finding is the funds are being more specific to say, I want to raise a fund to invest in solar, or I want an EV fund or EV value chain fund, and so on. So it's starting to get a little bit more dedicated as to where that capital is going to flow, making those big bets behind some of those verticals. Another big trend is today still a little bit trying to figure its way, but is in the whole carbon arena. So when I say carbon arena, this is quite a complicated space, but it's carbon-focused funds, it's exchanges, it's the trading phenomenon. It is how do you monetize and create those carbon credits and ensure that they have integrity. But that's a brewing world. Watch this space. What's interesting is it was very fringy 2 COPs ago. This last COP or this last Davos, that's all anybody was talking about. Every conversation was somehow sprinkled with how do we actually create a global price on carbon and ensure that the spread between the bid and the ask of people even buying credits starts to narrow, which would stimulate a functioning market. So you see lots of trends happening. The other one I'd point to, and then we can move on to the next question, is around sustainability-linked instruments. So a handful of years ago, SLLs, as we call them, so sustainability-linked loans and bonds, didn't exist. Burst onto the scene, it's a couple $100 billion market now, and this is when an issuer raises capital and commits to a series of KPIs that are sustainable. And if they were to, and it can go either way, if they were not to meet the KPIs, they get a hit to their cost of capital, or if they are able to meet their KPIs, they might get a reduction. And there's structures that work both ways. Those, I think, when they first hit the scene, were very provocative for investors because they say the issuer is putting their money where their mouth is. You know, they're putting themselves out there. I think the new version of this is having much more ambitious KPIs. I think at the beginning there was sort of, gee, is this BAU for the company and they're going to do it anyway, and they're just putting some KPIs that really don't matter one way or the other, or the cost of capital hit isn't all that much, so is it really driving behavior change? I actually was very optimistic about it because I think it signaled intent. So it may not have been the perfect thing, but this was a new phenomenon. So it's always the case when markets are just getting started that version 1.0 may not be perfect. But I do think that we will see a much more in the way of evolution about how that market will develop. But I don't think the appetite is going to wane in that space.
And I think, Alex, we see this trend in ventures as well. I mean, this is one area, as you talked about carbon credits. This is one area that we're dedicating at SE Ventures. But what's your perspective on the fintechs that we see and the opportunities in the space?
It's a brewing area as well. It's a brewing area, period. So first, quick reflection on the operating constraints we have at any point in time, which can be capital or skills and people, and you have to watch the two. And I think the crowding in effect you were mentioning is really having an impact from a capital perspective, with places, Vietnam or elsewhere being washed with capital, but perhaps lacking the skills to do this. In the fintech space, I think that it's exactly what ventures are about, right? Matching a bit of capital with human skills, entrepreneurship, and people knowing how to do something and wanting to do it, and we're obviously seeing more of this. I would just pause on what I think is a really important aspect of making the ventures that we're thinking about sort of viable, and making the green economy viable, which starts with measurable data. It starts with data. It starts with standards and people's ability to speak the same language across, from Vietnam to Indonesia to Singapore, and measure and ultimately talk about the same things. In as much as the area is brewing and lots of activities are emerging left, right, and center, there is a foundational activity, we think, which is absolutely paramount to get started, put in place, which is about data forensics and standards, and ensuring that people know what they measure and agree on that. At which point, we can build a lot of business models on the back of this, and that may well be the first commercial opportunity of all.
And I'll build a little bit on what Alex was mentioning a little bit about the term commercially viable, because something that we see a lot with not only our clients, and we're working with a lot of investors and real estate developers that essentially are very excited about creating the green buildings and the green infrastructure of tomorrow, is that we find that a lot of them are a bit too distracted about the idea of green finance. And they say, oh, I'm going to create this green thing, this green building, and it's going to be financed by green finance. And we tell them, listen, a bad project is a bad project, regardless of whether it's green or not. If you have a project that is not commercially viable, green finance is not going to save you. So the point that you were mentioning, Alex, a little bit earlier when you were talking about a project needs to be commercially viable, regardless of whether it's green or not, still remains true. That is, if you do a green project tomorrow, you want to start a renewable energy plant, for example, or you want to build a green building, it has to make sense from a commercial perspective. And then only do you think about how you're going to finance it, right? And so the thing that we tend to say a little bit from that perspective is, it's not about green finance, it's about green projects. And then your green projects, then you figure out how you finance it. And sometimes it will be through green finance because it makes more sense for you. And sometimes it will be through conventional finance. It doesn't have to be green finance at all. Normal loans, normal bonds will finance your green projects equally well. And actually, in the case of Asia, it's actually more, the cost of financing is higher for green finance than for conventional finance, because you need to go through cost of certifications, you need to go through a whole range of steps to actually get, you could say, categorized as green finance, as opposed to conventional finance is cheaper right now in Asia than it is. In Europe, it's the opposite, because in Europe, banks actually pressured to get a lot of green projects on their portfolios, so they lowered the cost of financing of green finance in order to attract a lot of people. But in Asia, it's still the opposite. So right now, if you want to do a green building, right, you don't necessarily need to think about green finance. All you need to think about, okay, how am I good? Is my green building, does it make sense from a financial perspective? And actually it makes a lot of sense, but we can talk about that later. Does it make sense from a commercial perspective? And then once the project is, oh, yeah, good, positive ROI, it meets my rates of return and everything, then you can figure out about the best financing. And right now in Asia, green finance might not necessarily be the primary channel.
I might just give a few caveats to what you said. I generally agree. I would say the one thing, though, that we see in the financial community in terms of trying to kickstart projects or investment opportunities that may be facing hurdles because of the lack of ability to demonstrate a commercial return at the outset, we will see catalytic capital providers come into play. So these might be concessionary finance actors that are prepared to take a less than market return, or we're seeing great philanthropists say that I want to be a part of the greening of the economy, so I'm going to use my capital to be that catalytic investment in the first instance, or even in the same project or capital stack, they might participate to crowd in the conventional commercial providers. So that's a term called blended finance. And that is also growing very, very rapidly, and that's in recognition that sometimes you need that little booster nudge in order to make something happen that otherwise wouldn't be yet commercially viable, but also necessary. And the view there is, if they do that at the beginning, then you'll create a velocity and a momentum to ultimately make those areas viable. So a good example of that is, the early days of wind and solar. The cost of creating those opportunities was so high, you wouldn't have commercial actors participate unless you had, it could have been catalytic at the front end, or it could have been off-takers at the back end. In that case, you had people agreeing to buy the supply at a higher price because they thought it was a good thing to do, and ultimately, the sector got to a scale where now a cost per unit of energy in wind and solar is cheaper than conventional. So that would be one area where I just give a slight caveat to what you said. The second thing is that we're seeing as well in many markets and beginning to have these discussions here in Singapore about whether or not governments should be giving you some nudges for green. So we saw in the US why the solar industry exists today in the US is because you had tax credits. And that created the entire industry when it wasn't otherwise commercially viable. Yeah. So policy nudge, and another area where we started to see that nudge happen is, for instance, in the UK for banks, the provision of green got a lower rating on your capital charges, your risk-weighted assets would have a little kicker, as we call it, for investing in green projects. And again, that is all policy saying we want to promote the green solution, and ultimately then they step back, right? After it starts to get going and it gets to a volume, then they're like, okay, we've funded this, now we can back off because it's commercial in its own right.
Yeah, of course.
Sorry, I was just going to add, in terms of demonstrating this commercial return, it's obviously critical to the kind of the longer term transition that's required, and the level of investment required to create these, to kind of limit the damage caused by carbon pricing, and in terms of macroeconomic damage, in terms of the inflationary environment, what's going to happen to the global economy, either from climate change or the impact of higher levels of carbon pricing. Part of this commercial return that we're talking about has to be in the context of a degree of certainty over a kind of carbon pricing pathway. And I think in terms of the policy environment that's been established, both from regulatory perspective and from these angles, it's kind of critical to demonstrating from the public perspective what what kind of the longer term trajectory may be. The longer it takes, the more expensive that will be for the macroeconomy.
I was just going to add, so it's building on all points, I think what's fascinating is we're really describing a period of adaptation where we're speaking about green finance. Finance is just a bunch of discounted cash flows. For us to be even talking about green finance as opposed to red finance means that we're really evolving and adapting. Over time, you would expect a convergence where finance is again finance, and it better be green because otherwise it will be unacceptable. And it could be unacceptable because it's illegal or because it doesn't yield the right returns. In which case, nobody would do it. How do you know it's unacceptable? Well, go back to data, go back to forensics, go back to knowing what you measure and establishing the standards that will provide the framework for financing. But you would expect that in a few years from now, we will have evolved from the crowding in process that we're experiencing now and spurring so much activity, and finance just becomes finance, and by definition, it's green.
I was just going to add one element, which is, Marisa, you mentioned incentives as a way to get people across the wall. But it probably works on the public sector quite well. How do we utilize incentives in the private sector? And I'm not talking about the big corporates, but especially their small suppliers along the supply chain to make these asset investments and so forth. Are there other solutions that we can provide?
Well, so if we're talking about maybe an SME market or those who might not otherwise always have the capital at hand in order to invest in greening up their activity, the best way the private sector can nudge is through the provision or the withholding of capital. So, for instance, if the capital demands that supply chain is cleaner, and we can then lend to those companies because they've made those investments, or if we say our capital comes only if you are subscribing to the following covenants. This is not a new phenomenon. I mean, from a financial point of view, the industry has long said, we don't lend to companies who don't support, pick your global practice, UN Global Compact or human rights. And those were ways to ensure that we've nudged actors in the entire value chain to participate in what we would say is a collective expectation of those that we're investing in. This is just a green version of that, right? We want you to subscribe to best practice, or we won't fund, companies who have, I don't know, you pick your thing. It could be deforestation, it could be, polluting oceans and rivers. And this is where I would say green finance is headed from a nudge point of view. If that's it, I assume that's not the question, that's where you're headed with the question, but it's all of that trying to tie our capital to some sort of activity or behavior change.
And so, Marisa, I think hits nail on the head. In my simple mind, it all leads back to just one thing: is the proper pricing, or is the proper costing of, you could say, a violation, right? So here we're talking about carbon emission, right? But it's actually across all the elements of sustainability. When we even regarding about circular economy and resource utilization, is the same thing, right? So from the point of view that you're assigning a cost to a unit of carbon being emitted, if that cost reaches a certain level where then it makes sense for a certain company to say, oh, okay, if I'm emitting this, it's going to cost me, so I'm going to pressure every single actors within my supply chain to act in a way that lowers that cost, right? That is essentially how it's going to hit it. There will be differences between companies that own their own supply chain and companies that do not own and act through basically, different suppliers. For example, I used to work for Samsung. Samsung has a very integrated supply chain all the way from the sourcing of the raw material that then use the manufacturing, that then blah, 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 blah. As soon as they say, okay, oh, wow, if I don't green my whole manufacturing process and my whole supply chain process, I'm going to be hit by $100 million of taxes every year. Then they will have, once it reaches a certain level, an incentive to redesign their entire supply chain. But even if you don't own it, If you're big enough a company, then you're going to pressure essentially all the suppliers, and they're going to pressure their own suppliers, they're going to pressure their own suppliers. It's going to have a trickle-down effect. But the real question of what is the right carbon tax, so that it links to that point where there is an inflection point where it starts making sense, changing your entire supply chain is the big question, right? And right now, a lot of people are saying that carbon tax is not high enough to create these incentives, right, to change across the supply chain. Right now, people would rather absorb the costs rather than going through that, you could say, that change management across a whole supply chain. And that's something that right now is really focused on carbon, but a lot of people are now starting to think about it for material usage, notably in fast fashion. For example, they're talking about how much chemicals, water is being used, and as well how much waste is generated by this industry, and how much of the cost of that then should be borne by the fashion industry. And if that cost is high enough, then they'll be like, oh, maybe we don't need to create a new line of clothing every 3 months, or maybe we shouldn't be using polyester because it's hitting our P&L. So all of how the whole question at the end of the day of the incentives is how do you start transferring some of that cost right now that is being borne by government and people and the environment into the main, you could say, culprits and creators.
So this is the biggest case study of market failure. In fact, some of our grandchildren will be writing PhDs wondering how our generation, the stupid generation, sort of lived with the biggest market failure of all times, which we're describing. And what you're saying is society's one cop after another, sort of coming to terms with the fact that one, there's an element of the market failure here, but also how do we address it and how do we price it. To your point on supply chain, data, and an element of technology, right? Lots of foundational technologies have come out, which are very relevant. Blockchain is a foundation technology; it makes things really transparent and immutable and all that. And it's a ledger, but it's a very cool ledger.
And just on blockchain,
yeah,
with the recent merge, the fact that we're using a lot less energy to produce
as
all
a
that.
separate matter, yes, as a separate matter. Internet of Things, smart cities, tracking goods in a supply chain, tracking commodities in agri-tech, and other foundational technology. Data science is a foundation technology. So applying these technologies to the use case of tracking stuff and pricing it appropriately according to certain market standards in a supply chain, having the sort of information that Samsung probably has, and lots of companies think they have, but may not completely have, may not be pricing appropriately. It's obviously another use case, and again a commercial opportunity and a business case that we can get applied to.
I wanted to react on something that Brice said, which is it comes back to if we set aside the carrot and stick approach, which I think is sort of the recommended approach for the next 5 to 10 years to get everybody on board. But do you feel there will be a situation when we don't have to choose anymore between being commercially viable and choosing green? Do you think we're approaching a situation like that in specific markets or specific industries?
I cannot speak for the whole economy, but I know. So I'll give you an example where it's already the case, right? So when we're looking right now, again, we're working with a lot of developers across Singapore and the region, CapitaLand, Capital, and whatnot, on green building and the future of green buildings in the region, right? Vastly interesting topics. And right now, a lot of developers are still saying it costs us more to design a green building than to design a conventional building. And that's only because they only approach green as a cost, but they don't look at the impact on revenue and on profitability later on. And something that they're not seeing, and right now we're actually running a training for all of these guys where we're telling them, look at this, is doing green building right now is not only an additional cost, but it's also a huge additional revenue. Why? Because right now there is a very rapidly increasing demand for green building and green offices across the region, which means that if you're Google, if you're Facebook, if you're any of these companies right now, right, you're getting pressure in the market to reduce your carbon emission. The easiest way for you to do this is to move on to an office that is low carbon. That's easiest, right? You're like, you need to restructure your operations and your manufacturing. That's fine, it's going to take a long time. But the first thing you're going to do is, oh, okay, let me move to an office that is low carbon, like this, I'll be able to report it, it's going to be low carbon. So the demand for carbon-free or net zero buildings is about to skyrocket, and it's already skyrocketing in Europe, and it's about to do that. Now, if you right now, today, as a developer, building a building that is not net zero carbon, in 10 years, nobody will want to move into it. Which means that you have an asset, a building, you're expecting to make a lot of rental income in the next 30 years, but actually that rental income will do this because fewer and fewer people will want to move there, and you actually will have to reduce the rent on it over time. And so when you look at it, not purely from a cost perspective, it's higher indeed to do a net zero building, but from the cost, right? But from a revenue perspective, the additional cost that you're going to put at the beginning is actually going to protect your rental income for the next 20, 30 to 40 years. Whereas if you're doing right now a building that is not net zero, the income that you're going to get out of that building is going to get threatened and threatened and threatened. So it's not going to be a stranded asset, as we call it, it's going to be a degraded asset, right? So from that perspective, right now, from a building standpoint, the choice is not, it does not exist anymore.
I can actually give you one better. So in Europe, there's the leading green building retrofitter will tell you today that he can absorb the cost of retrofitting to green entirely because they can charge higher rents. So it's not even attraction of people who want to be green. It's actually being able to price. And so this individual has more than he can handle in terms of the demand for people who want to retrofit to green, but the pricing element is already there, it's baked into the market. To answer your question on what industries, just as I said, solar per unit of energy is cheaper now. Wind is per unit of energy produced is cheaper now, and that decline curve will happen so much faster than any scientists or modelers were predicting. And it was decades ahead of where they thought it was going to be when it crossed over. The other area where I would say if you want to look at it rather than an industry lens, but an asset class lens, in Europe, and it waxes and wanes a little bit because markets are volatile, but we have this notion of a greenium or a green premium for green bonds. And because the supply demand is such that you have more demand than supply, if you're an issuer, you get a lower cost of capital to do a green bond than a conventional bond. And that is absorbing the additional cost of getting your third-party provider. So you have these folks that have to come and vet the greenness and come and check you once a year that you're following the green bond principles and so on. But that's a tiny one-off consulting fee that you pay if you're thinking about a couple $100 million euro bond issue, and you can save 10 or 15 basis points. You absorb that cost and more by multiple factors. So there's many, many ways where you can point to the fact that it is cheaper to do green. Now, it's not everywhere, it's not every asset class, and it's not every industry, but that is a bit the direction of travel.
Yep. And I think a lot of what we're mentioning is also in the B2B environment. I recall a venture that we are launching actually in Europe, where we asked the venture to test. It's a sustainable deposit solution called Shoal, where we asked the venture to test whether people were interested in investing in green assets or whether because it was a better rate, basically. And I remember you being quite adamant about the fact that we have to know why people are interested in this. So do you think at the B2C level, people are going to be as well investing more into green assets?
Emphatically, yes, undeniably. It's you just need to watch the behaviors of next generations and increasingly consumers overall, and the way we buy or don't buy, the way we travel or don't travel, the way we live our lives, generally speaking. that's evolving. It's evolving fast, and so I think that applies to the way we place our money in deposits and invest, undeniably. So yeah, I was adamant that we need to quantify it and understand it, and then go a level of detail deeper in the context of the venture you're alluding to, and that's exactly the process we're going through right now. But are we onto something? No question.
Yeah, I was just going to say, just to scale this up to kind of macroeconomic perspective as well, when you look at this, how it plays out over 10, 20, 30 years, the reason this makes sense to move quickly and to create this environment from a governmental perspective is that the kind of things that make climate mitigation expensive that are the things that reduce our kind of productive capacity in the economy. That's kind of the degradation of these capital assets, it's the stranded assets, it's the kind of imposition of high carbon pricing. And the sooner that we move away from that, we're kind of limiting that cost. The sooner you start to, this thing accelerates, means that those assets can be upgraded within the natural investment cycle instead of just kind of massive kind of wiping value off the balance sheets, as well as wiping kind of productive capacity out of the economy. So when you look over this macro modelling framework that we engage in, this is the kind of variable that really makes a difference as to whether reaching a net zero emissions environment is something that degrades global GDP or actually is balanced out by higher investment and more production.
I'll end with one question that I will ask collectively, and then we can open up for Q&A. What are some of your predictions for the next 5 to 10 years in terms of green finance and adaptation to green economy?
Oh, sorry,
Oh, you get to go first then.
Maybe
Only the
at
hot
venture
mic.
level.
I think we stumble on it in the conversation. One prediction is finance just becomes green, in theory. So convergence and of that differentiation, and clearly a vector of entrepreneurialism, activity, investment, business for some time to come, which is just starting.
I will predict that for every industry that exists, there'll be at least 3 disruptors that are beyond unicorns that will emerge that we haven't even thought of today. That'll be one. So get to work, my partner. The second one will be that we will begin to price in these exogenous factors that the market has historically not been able to price, or not, maybe not been able to price, not even thought about pricing, but I think we will start to see frameworks for how to do that, whether that's carbon taxes or other. And that includes pricing in negative effects on nature. There's a lot of very, very amazing work that's going on in trying to price what we're doing for biodiversity destruction, for instance. And as we begin to absorb that and put that into the financial system, that will create the behavior change that we want to see about nature conservation in particular. And then the final one, my big prediction, but do not trade on this one, is that we will have a carbon price that will hopefully come together, and we will reduce the bid-ask spread on carbon by a measurable degree. And I'm kind of predicting that we'll definitely be over $200 for a ton of high-quality carbon credits.
Brice and James?
I'm predicting whatever I have to say will be wrong.
I was about to say that.
Oh, the economist called out.
I'm sorry. Yeah, I'll have to say some other things. So this morning I was actually putting some Nutella on my daughter's toast, and she looks at me and she's 7 years old, and she's like, "Dad, I don't want Nutella anymore. There's palm oil in it, and we're killing the orangutan." And so my prediction is that the type of thing that we're thinking about the kind of the future is going to be the baseline for our children's generation, and I think it reaches it's not going to be about green finance, green economy. It's going to be finance and economy, and hopefully our kids will hold us accountable. That's it.
Great. Well, thank you very much. Thank you. I'm going to pass it over to the audience if there's any questions to our panelists.
Thank you so much for the. Okay. Thank you so much for the insightful sharing. I'm Ivy. I'm an energy transition and carbon specialist with S&P Global. So my first question is about whether we really have the standards or guidelines that are necessary and comprehensive for today. Because, I talk to some so-called sustainability bankers nowadays, and I understand they have lots of headaches actually when it comes to real daily operation. For example, whether I should provide this green loan to a specific project. Every bank, almost every bank, have their own metrics or benchmarks. There's no uniform standards. Or whether we should issue letter of credit to a specific carbon neutrality commodity. Because the LNG commodity have its own associated risk, but for the carbon credits behind the risks, there's no uniform way to evaluate. So my first question, in short, is whether the current frameworks for standards are comprehensive, and what's your key messages to the regulators to complete this metrics? Thank you.
Sure, I think just by highlighting what you highlighted, I think you have answered your question in the sense that we're not where we need to be today. We do need much more in the way of guidance of what good looks like or should be. That is also, though, very much consistent with the early development of a market. We've seen this in every asset class that's been developed over time. Alluded to that a little bit earlier, that markets begins to develop. You begin to get a common adopted set of principles and standards. Those aren't right the first time around, and they get better over time, and I think that's sort of where we are in the carbon space. You see coalitions forming that are very much attacking this problem. So for instance, the Voluntary Carbon Markets Integrity Council, it's a mouthful, which is made up of public and private sector actors, civil society, etc., all coming together to say, we want to create a set of standards for the voluntary carbon markets that the market can have confidence in. And the key to me is when you have a set of market adopted principles, you create that confidence and then trade begins to flow. So we are in that, I'd say in the middle of that journey right now, but there's an enormous amount of will and a lot of momentum behind that. So I'm optimistic that we will get to something that will help these markets to be less fragmented.
I was just going to add, stay tuned. So, the short answer to your question is no, we don't. And so that's a muscle which we need to build in Marisa's organization, in every sustainable finance organization. And therefore, it's also a commercial opportunity, and we're working on it.
We're building that.
So stay tuned.
So actually, the answer to your question has two layers. There is the credit, or you could say the ESG rating layer, which is what you were talking about. But you also have the reporting layer. So when you're talking about, that is the standards and frameworks that companies are using to report on their carbon or their sustainability or ESG strategy, right? These are two different things, right? One is used by financial industries to assess non-financial companies, and the other one is used by non-financial companies to report, right? And first of all, these two are not really talking to each other as much. And the issue of fragmentation that you're talking about is happening at these two levels, not only from an ESG rating that the financial industry is using, but as well from a company reporting, which is, you have GRI, you have SSB, you have TCFD, you have all that stuff, right? So the issue of fragmentation that you're talking about is happening at these two layers, and they need to it's not a question of comprehensive. I think it's a question of, as you say, uniformization, because right now you have all these things popping up, but nobody's really knowing which one to use, which one is the best one, and you have a lot of initiative, notably IFRS, whose main goal is to bring the things into a uniform standard. So when you're looking at the general accounting principles, for example, that companies are using to report their accounting, it's an excellent example of something that went through several iterations to land on a uniform standard for everybody to use. But that uniformization is not the only you could say inflection point. The other one is enforcement, because you can have uniform standard if they're not enforced, or if there is not a sanction to those that do not follow them, then you have a problem.
there's an element of sanction right now from the financial market. That is, if you don't meet these ESG criteria, you're not eligible to be part of ESG portfolios, for example. But in terms of reporting right now, you don't have sanctions, you don't have punishment if you don't essentially report and if you don't meet certain sustainability targets. That is, right now, you can report on GRI, purely voluntary. Nobody's really checking what you're doing. Maybe there's some, third party, Big Four is basically checking, but whether you're meeting your target or not, nobody cares, right?
I think it depends on markets.
Yeah,
like in Japan, for example,
yeah.
it's become mandatory.
Yeah.
But I would go back to what Alex was saying. We are working on a venture around that specifically. Hopefully. Marisa, you wanted to?
Just that actually, the regulators in markets are mandating how you report. TCFD is a version of that. That is now a requirement. It used to be, and this is again part of the evolution. When it started, it was an idea that was born by the then governor of the Bank of England, Mark Carney, getting banks and asset managers around the table to say, we would like you to report and disclose on your exposure to green and brown assets. That very quickly became comply or explain, which is typically the way the regulator works when you're in development and no one has that capability yet. Yeah. And then it goes from comply or explain to you must. And if you don't, we will sanction you. Yeah. So we are now at the mandatory stage where TCFD is a requirement for banks. So I think that's a very good example of the direction of travel. Now, the one thing I would point to, which is more challenging, is that every regulator has a different standard. Now, TCFD is largely adopted now globally, but the difficult thing if you're a global organization, whether you're a company or a bank, is when you have regulators in 5 different markets, all with a different green taxonomy. Dealing with that is I think, another challenge that I would point to. We're working our way through it. And also on the accounting front, there is consolidation. You're absolutely right. In the US, it was SASB, Sustainable Accounting Standards Board. In Europe, it was GRI, then you had IFRS. They're all now coming together under the umbrella of ISSB, International Sustainable Standards Board, I think it is, that's trying to bring all this together. It's still early days, but this is exactly what we expect to see happen is you start out with lots of fragmentation, and then you have consolidation, then you have market adopted standards.
I think we have time for maybe 1 or 2 more questions. I think you had one more?
Yeah, I will keep the question short. So my next question is about financial support to the most expensive or capital intensive areas. For example, in US, there's IRA to support, for example, CCUS. And for EU, they're coming up with their own IRA version as well. But in our region, do we have such kind of strong support to those most expensive sectors? Thank you.
We see similar developments, but in different flavors is maybe the way to put it succinctly. So yes, US has often been led by tax incentives. That's what drives a lot of US investment, and that's what the IRA is a lot about, is that we give you credit for investing in certain industries that we want to promote. It's not just carbon capture, it's anything green. IRA is actually being applied to all sorts of things, solar, green, hydrogen, etc. So it's about unlocking some of these emergent technologies. The EU's response is trying to figure it out. They typically haven't been so much on the tax incentive side. They have done things like capital relief, and this is what I was speaking of earlier, that banks get a reduction on their capital hit to directing their loans toward green. And we see where certainly the regulator here, MAS, is asking for best practice. They're soliciting right now a lot of input on what sorts of incentives and or penalties, it works both ways, to jumpstart a lot of these newer technologies. So I think you're going to start to see this proliferate. Regulators talk to each other around the world. Now, they may not all be in harmony, but they are looking to each other for the ways that are going to be most successful to drive this green economy.
We have time for one more question.
Hello there.
2 more questions. 2 more questions.
Thank you for the very interesting panel. I guess one of the questions I always wonder is, and if maybe the panel could answer, is kind of what are some of the barriers holding back institutional investors from investing more in green tech and startups, and what can be done to bridge that gap?
So maybe we can start at institutional level and then we'll go into ventures, or
James, you have
So I think it depends when you say ventures, because the largest institutional investors, their biggest pools of capital are usually allocated toward liquid securities that you can trade in, so public equities, public debt. If you looked at the pie chart of the capital they run, that's the biggest slice, are liquid markets. So when you say ventures, the first thing is just a natural phenomenon that their allocations to private investments are smaller, so that would include all private, so it could be private equity or others that is, an illiquid investment. And then even a tinier slice from the large institutional investors would be allocated to venture. So that's no different than, the green phenomenon is just if you look at overall percentage flows to allocate to those different buckets, you're smaller in illiquid because it's higher risk, higher return. But for those dedicated venture funds, we're seeing more and more form themselves in wanting to invest in green, or what I call innovative, disruptive tech in the sustainability sector. So of the slice of the global pie that goes to venture, you'll probably have stats more than I would, but I see when I interact with those capital providers, they're asking for green solutions. And that is very much what we were talking about on the panel today. They see the prospect of enormous value creation, and it's almost, the only way is a sustainable way to this idea that we're all gonna merge to green. So I think that that's what leaves us hopeful. And at the same time, because out of necessity, you're seeing so much innovation happen. That was my prediction, that you're gonna see 1 or 2 or 3 really just big disruptors per industry. It'll be the next Elon Musk of whatever industry. There, we see those technologies happening because they're solving a really big environmental or social problem for their industry, and they are definitely able to attract enthusiasm and capital.
I think maybe just one stat, because you did ask for one stat. So in venture capital in 2022, there was a report that was done by PwC that showed that 25% of all capital invested was towards a green project, green venture, or green technology. So it's not yet 50%, but it shows a progression in the private markets.
Of the venture.
Of all venture cap, 25% in 2022 went to a green venture.
You guys covered it extensively. I would only add what we touched on in the previous question, which is data and forensics.
Hello, Viviana from News Asia. Just one question. There will be, as you mentioned, there will be more specific funds or sustainability links funds, instruments. How do you see the involvement of the private investors in these areas together with banks and other, investors? Because some people also talk about alternative assets. Will this be like one of the alternative assets that you think will be an ongoing trend in the future?
So there's the term of art alternative investments, and then there's alternative, which may be the green version. So I'm not sure which one specifically you're referring to, but when we typically talk about alternative investments, it's non-public liquid, that bucket we were talking about. If we're talking about alternative meaning the green version versus the traditional version, in terms of who the investors are, I will tell you it is across the piece. You have large institutional investors who care. You have private wealth who cares. In particular, in my old life, I used to work for a bank that had a very large, ultra high net worth private wealth business. And we were creating funds that were specifically dedicated toward ultra high net worth investors who could write very, very large checks. And we were raising a couple $100 million at a clip, in terms of funds that were very dedicated to specific, usually environmental topics. So whether it's oceans or circular economy or EV, you found a lot of enthusiasm at a very individual personal level from wealthy families. Another category would be the sovereign wealth community. That is another huge, here we have Temasek, you have GIC. If you look at the percentage of the capital that they would like to dedicate, Mubadala in the Middle East, I mean, they just kind of go on and on. You will see that they are increasingly allocating more and more of their sovereign wealth monies to sustainability. And why? Back to the very fundamental point here, which is that is the way of the future. And they see the value creation, but they also, particularly with sovereign wealth, what are they doing? In a way, they're indirectly feeding the future of their economies. That's what they're stewards of their countries, and they see, that kind of potential for the future. So.
Great. Well, thank you very much. I want to thank my panelists for today's session. We can actually network a little bit for the next 20-25 minutes. We have refreshments and snacks for the audience. Thank you very much.